Hello, everybody. This is MattyP, here with Bronson Kaufusi, as always, your host of the HIG Podcast. What's up, Bronson?
Hey, everyone. What's going on?
How you doing, man?
I'm doing good.
All right.
Yeah, that's nice.
Christmas is around the corner.
Right around the corner.
Have you been a good boy?
I have been. I've been hiding Elf on the Shelf every night.
You mean looking for the elf on the shelf?
Yes.
After the elf moves.
Yes.
Yeah.
That's right. That's right. He
Yeah.
moves every night. It's crazy.
I knew that's what you meant. You know, the weirdest thing that happens at my house, too.
Oh,
So-
you have an elf issue.
Yeah. In fact, the elf at my house has a burn right in its stomach because one time it decided to hide in a light.
That's awesome. Oh, man.
Yeah, very mischievous, but it was a great hiding place.
Yeah.
You know, the kids, they couldn't find her for a while. So
Yeah.
long enough to get a hole burned right through her shirt. I should probably not say that, though.
Yeah.
Anyway, we are here today with something pretty special. We're kind of veering off our regular course because recently, if you've listened to the episodes that we have here, you've heard us talk about the lecture series that we have, right? Lecture series with Jason, where he gets up and he talks about a few key elements of his tax and wealth strategy that got him to where he is today. Bits of knowledge and wisdom that, you know, he wants to pass on to other people. And recently he gave his lecture on tax strategy. Now, Bronson, have you heard Jason talk about his tax strategy before?
You know what? I have, and I actually get excited every time I listen to it because I had never heard it before until I met Jason Harris. So when he was telling me about it, I was super excited because it was just new information. So, and for me, I really enjoy, when people are really passionate about something that they're talking to me about or they're educating me about, I can tell. And it makes it enjoyable to listen to that individual. And almost like they could go, it makes learning fun. And Jason is very passionate about tax strategy and, all the things that he's learned along the way. And it's really interesting too, because, tax strategy or tax law can change. And so, you're adapting, things are moving, you're trying to work alongside the government, trying to figure out things. And it's fun to listen to Jason talk about it every time, honestly.
It really is. It's funny because he kind of like preambles it with, now I know that taxes aren't exciting, but I have some really exciting stuff to talk about. And then he goes into how beneficial tax strategy has been for him and for us at Harris Investment Group, how it's really helped us find a lot of investors to work with. And so I should probably mention, this is going to be part one of a two-part series. His lecture was about an hour long, so we're going to break it up. And so on part one today, he talks about his tax strategy and the game of wealth creation, which is pretty cool.
Yeah.
He talks about partnering with the government. How if you look at it like it's a game, the government will really help you build your wealth creation. So it's the role of the people and the role of the government. One of the coolest things that he said in here, and you guys will have to listen for it when it comes up. Do you know how much of the tax code is actually written specifically for paying taxes? I didn't know this until he said this.
Not a lot.
It's 0.5%.
Yeah.
So 99.5% of the tax code is written to help you keep your money.
Isn't that cool?
And then he talks a little bit about 7 areas that the government incentivizes the people, which is where that 99.5% of the tax code comes in. He gives a nice case study. You can't see the visuals, unfortunately, but he talks about a cost segregation study and depreciation and how those two kind of play together.
Cool.
And it's all just centered around keeping more of what you earn.
That's how you accelerate your wealth.
It is, and Jason's a master of it. He's done really well.
He is.
And it's fun to watch him, kind of pass on the torch and educate people and to see them get excited about.
Yeah, people get very
taxes.
excited.
I know, right?
He can do that.
Yeah. Before we get too far into this, it is important for us to mention that we are not providing tax, legal, or accounting advice. This episode of the HIG Podcast has been prepared for informational and educational purposes only. If you have any questions about this, check out the homepage of the HIG Podcast. On this specific episode, we have our complete disclaimer in our notes. So, without further ado, here is Jason Harris and his lecture on tax strategy. Enjoy.
Most people don't get all that excited when we talk about taxes. Funny enough, talking tax has been a way that has really helped us identify people who are needing a better strategy. So I guess for those of you who haven't come before, what is your biggest expense, do you think, in life? Mortgage? Sometimes I hear your spouse, your kids, they can be pretty expensive too, but taxes are probably going to be your biggest expense. So Tony Robbins, Money Master the Game, talks about 68% of expenses throughout your life go to taxes. And if you think about it, we've got federal tax, state tax, FICA tax, which is a payroll tax. When you go to the pump, there's a gasoline tax, there's an estate tax or a death tax. There are all kinds of taxes. Any of you, we bought the pizza and donuts tonight, we paid a sales tax on it. There are taxes on everything that we purchase. And the biggest expense is going to be your federal and your state taxes. Because we're in a progressive tax system, the more you make, typically, the more marginally higher your tax rate is until you get to the highest tax rate. And if you live in Utah, that could be over 40 cents on the dollar. Everything that you make, you're given to the IRS. So taxes are such a big part of the expense column. And what you can do to reduce your tax burden will make a bigger difference to what I think is more of the wealth strategy. And so there are ways that we want to try to expand our means to make more income, reduce our cost, and in the process of doing that, we're able to keep more, keeping more of our hard-earned money of what we're working towards. Well, a big part of that is reducing the tax drag and tax burden or tax liability that you have on what you're making. And the more that you can keep and not give to the IRS, you're able to then put that to work and have it compound and grow for you. And so I want to talk about some things that I've learned along my years in wealth management, working with some family offices and some very successful people, of what they've done to grow their wealth tax efficiently. Because in a way, it is a game. We're all in the game, regardless if you know the game's going on. And we're all partners with the government. Some of us are just better partners than others. And every year, you get a score based on how well your tax return turned out. And the way that you score your scorecard is based on how much your effective tax rate is and how much money you gave to the government versus keeping for yourself. And so that's what we're going to talk a little bit more about tonight. How can we keep more of what we earn and our hard-earned money? And of what we're keeping, how can we make it work harder for us so that there's not a big tax drag? All of us at some point hopefully are able to invest money, and we want that to grow. But if you don't have that money grow tax efficiently, you're going to end up having to pay taxes on a lot of the growth and the gains. Where otherwise, had you done it more tax efficiently, all of the growth could be yours to keep and make an impact. And hopefully you have everything you need for your own benefit and family, so then you can make an impact on others and give and share and contribute to the world and to other causes that you're passionate about. And so a judge in a court case back in 1934 said, anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will best pay the treasury. There's not even a patriotic duty to increase one's taxes. There is a misconception that paying more in taxes means that maybe you're more patriotic than someone else, or that if you don't want to pay taxes, that somehow you're not patriotic. And I hope to debunk some of this misunderstanding about reducing one's tax liability, because tax avoidance is legal. And in fact, you could argue even patriotic. And I'm going to try to showcase why the government is willing to give so many tax incentives, deductions, and credits to us, the American people, because there are important things that the government need to have happen that they can't solve themselves without the help of the American people. And that is why they offer tax deductions and incentives and credits, so we, the people, will take care of the problems that the government needs to solve. And it's a lot cheaper, more effective, and less expensive for us to do it than for the government to try to solve it themselves. Who would agree that our government's probably not efficient? Have you ever tried to call into the IRS and get someone? It is the most painful process. I have a 2017 tax filing that I made an amendment of, that I went from owing taxes to not owing anything. And then about 2 years later, I find out some of my properties were getting liened because they said I owed taxes from a 2017 tax filing. I called into the IRS. It took about 2 hours, so I actually had to have a team member wait on hold for me. Finally, someone answers, and then what I learn is they're liening all my property because I haven't paid this tax revenue that I owe. Well, I explained, I made an amendment, and when I made my amendment, I didn't owe that tax anymore. In fact, you guys owe me money because I paid in more than what I rightfully owed. Funny enough, not funny at all, it wasn't funny at the time, but funny now I look at it. They said, unfortunately, we have not recognized your amended return, and if you don't pay, we can still move forward liening your property. And so what happened is I had to create a payment plan because I didn't want to pay it off in full. So I set up a 5-year payment plan to pay back this 2017 tax revenue that I didn't owe, and I am still paying on it in 2024. And I don't even owe the money. And so that just is to explain the inefficiencies of our government, that they need us, the American people, because we will solve the problems that the government has far better than the public sector can. And it's even smarter for them too, because the only way that the government makes money is through taxing the people. And it's through the tax revenue that they create jobs. But that's a dollar for dollar benefit. If the government gives a tax incentive to a business owner, the business owner takes its own capital and own risk to employ the American people. And so it's far better for the government to give a tax incentive to a business owner than to go create jobs dollar for dollar that we, the people, would have to pay. So how do we win the game? The game of tax strategy, the game of wealth creation. Well, the objective is building wealth that'll never be taxed. So it's not just about building wealth. It's also about building wealth that has a permanent tax deduction or tax benefit to you. How do we build wealth and have it never be taxed? Well, here's some of the rules. We're partners with the government. Whether you know it or not, we're partners with the government, and every year we get to decide how that partnership went, and that's part of our tax filing. Number 2, we need to understand the rules completely and be disciplined enough to play the game to the best of your ability within the rules. And number 3, the object is to not merely reduce taxes, it's to build wealth that will never be taxed. And so that's the rule, and the game is building wealth and doing it tax efficiently. So I'm going to share with you some ways that I've been able to do that. A couple benefits of the tax law though. Your money is your money. It's not the government's money. Some people have this misconception that the government does rightfully have rights to your money. No, this is your hard-earned money, and it is your money to keep. Now, that doesn't remove the government being your partner, right? And so you have to understand how that partnership works, but at the end of the day, it's your money. And the tax law is written primarily to reduce your taxes legally. So I just looked this up. How many pages in the tax code do you think there are? What? 100,000. It feels like it. There's no way anyone's ever going to understand all the tax law and tax code. Even those who we've hired, the 70,000 people to enforce the tax law as auditors, don't know the tax law. In fact, I've been audited and I've seen how those audits work, and I had to teach the auditor a lot about taxes that he didn't know. 6,871 pages are in the tax code. Of those 6,871 pages, 35 pages are why you need to pay taxes. The remaining tax code, 99.5%, is why you actually don't have to pay taxes. that are a part of the 35 pages that say you do. 99.5% of tax law is about why you don't need to pay taxes. It's incentives, it's credits, it's deductions. And if you're willing to understand your partnership with the government and do the necessary activities that the government needs, they are willing to give you tax breaks, tax incentives, and tax credits. So let's figure out what the rules are and find the best way to grow wealth and do it tax efficiently. 5 goals of every government. This is not just the U.S., but all governments everywhere. Keep the peace. You know, there's major problems of war and even inside our country if you can't keep the peace among the American people. Protect the people, feed the people, shelter the people, educate the people. All of the tax laws and incentives are based on these 5 key areas and goals that all governments have. So as a part of that, there are incentives within these 7 categories. Business, technology, so R&Ds, research and development credits are more or less what those are. Real estate, housing, energy, agriculture, insurance, and retirement. I've probably been a part of all 7 of these categories, but tonight, for what we want to go through, I'm going to focus my efforts on real estate and incorporate a little bit of business and retirement, but all 7 of these have some very fantastic tax incentives. And based on your industry and interest or passion, there's really great tax benefits within these 7 categories. So let's talk a little bit about real estate specifically. My passion, I have a lot of experience within the real estate game. I started early in life, and it's been a big part of my wealth creation of helping me grow wealth tax efficiently. So I want to talk about some of the things I've done, but also that I've done with many other investor partners and people smarter and far more successful than me that I've learned from them of what they've done. And I broke it up into 6 different categories. Depreciation, or some of you may know bonus depreciation loss. Real estate professional status, which incorporates that, and I'm going to explain a little bit about what that is. Retirement and retirement plan conversions, which is pretty fun. For any of you who have a 401k or IRA, that could be a fun discussion that we're going to talk about. 1031 exchanges, opportunity zones, and primary residence tax exclusion. We're going to talk about depreciation first. Before I go further, just so I have a better idea of the room, who here owns an investment property by raise of hands? Oh, okay, a good number of you then. Okay, so most of these benefits apply for those that have a business or investment intent. You can own real estate, but have it be personal intent only, meaning it's a personal benefit. So you're like your primary home. There's not really any type of offer that you're adding value to the government to shelter the American people. If you owned an apartment or a single family home, it would. There are more tax benefits and incentives when you're helping others than when you're helping yourself. However, the primary residence tax exclusion is still a benefit, and I'm going to talk about it. But most of the best benefits are when you're helping others. And it's when you're helping others, you're solving the solution for sheltering the American people. And so depreciation is one of the best ones. So depreciation is a phantom loss. It's a non-cash expense. Most deductions in the tax code, you have to spend money in order to get a benefit. Let's just say in the building I have a water heater that goes out. If I replace the water heater and it costs me $2,000 to do so, I literally spent $2,000, and the government then will let me deduct that from my income so I don't have to pay taxes on that money. And if I'm in the 40% tax rate between federal and state, that's a 40% discount. That means I get 40% off the $2,000. Well, depreciation is one of only 2 tax benefits and tax deductions in the tax code that are considered non-cash expenses. You don't have to spend money in order to get the benefit. Can you imagine if you had all kinds of these depreciation deductions and you didn't have to spend any money in order to get them? That's the best kind of benefit. And so I've looked for ways to get as many of these benefits as I possibly can without spending money in order to use those benefits. And so let's talk a little bit about how one could do that and what this depreciation is. Technically, depreciation is a loss that the IRS gives you that says when you buy a property, let's call it this building, if you don't take care of it over enough years, eventually it will lose its useful intent. It will eventually be dilapidated and destroyed and ruined, and no longer could you use it as an operational building. It'll have to be torn down. And so they have decided for commercial, that's 39 years. For residential properties, it's 27 and a half years. That means on straight line method depreciation, if you buy a building, you get to depreciate that building over 27 and a half years if it's residential or 39 years if it's commercial. And the reason they do that is because, again, if you don't take care of the building, eventually it'll have to be torn down. However, what's so interesting, what I love about real estate is it's an appreciating asset. Typically, real estate actually goes up in value over time. So it's one of these great places to put money where your money can actually grow and appreciate while also getting a deduction that the IRS offers despite you're actually getting an appreciating asset. There's two ways for you to take that depreciation though. You can either file with the straight line method, which is the one I just explained, where you just divide it over 27 and a half years. That loss then passes through to you in a K-1 or on your Schedule E. And that loss of whatever it is can now be a deduction. It's called a passive loss. And you can use it to offset income that you have on your tax return. Primarily passive income sources because it's a passive loss. So passive income is cash flow, but any other private equity investment is also considered passive in nature. So that loss can offset other passive income sources. And I know this is complicated for some of you. I'm going to try to simplify as much as I can, but I promise there's some really cool aspects to this if you can stay with me as much as possible. The other method is the accelerated method or the accrual method. This method is actually considered the most accurate. If you think about this building, are all of the items of this building going to go down and depreciate over the same lifespan? Of course not. Like carpet, I'm going to have to replace this carpet like every 5 years, especially all the mess I saw you with your pizza earlier. I'm totally kidding. But I'm just saying that's not going to last anywhere near as long as the infrastructure of the building, right? The foundation of this building could last 100 years potentially. So the point is, on a cost segregation study or the accelerated method, we do a study to actually give the real useful life of every item of the building. This may be 5 years, my cabinets may be 15, the infrastructure is 39. This study will show to the CPA the actual useful life and the allocated value within the purchase price that you paid, where those values are. And then with that study, they give you the depreciation based off of what that study says. 5-year items, 7 years, 15. So instead of getting a depreciation that's equal over many, many years, 27 and a half, you get a lot more depreciation up front. In 2017, President Trump, came out with the Tax Cut and Jobs Act. It made the depreciation far better and far greater than it has ever been. Through these cost segregation studies, no longer did you have to wait 5, 7, 15 years to get your depreciation. Again, phantom loss, that's not real. You now get what's called bonus. Anything that's considered a 20-year life item or less on the cost segregation study gets to be written off in the very first year. So if 30% of this building was 5, 7, or 15-year life items on that cost seg study, I got a 30% write-off of what I paid for the building. Let's just pretend I paid $20 million. That means 30% of $20 million would be a $6 million write-off. I now get to take $6 million as a phantom loss and use that loss to offset other income, passive income sources I have on my tax return. That's the accelerated method. That's what a cost segregation study is. Just to wrap up the depreciation, it's a phantom loss. Phantom means it's just not real. You're not really losing the money, right? You get this deduction, but you're not really actually getting a loss. You didn't actually spend money to replace a water heater despite still getting that write-off and that loss. And it's the best non-cash expense of the tax code. These tax benefits can outperform your cash flow. So most of the time, the depreciation is more than your positive cash flow. Positive cash flow on your real estate is taxable. However, because of the depreciation, you can use it to offset that cash flow from being taxable. So that's a nice benefit. The other thing that is nice is in our current tax code, we have what's called a stepped up in cost basis. So if you bought this $20 million building, held it for 30 plus years, and when you die, it was worth $50 million. Your kids, or whoever your beneficiaries are, would actually be able to receive that $50 million building without having to pay taxes on the gain. The $20 million that went to $50 million is a $30 million capital gain. You don't have to pay tax. Well, me, the owner, if I keep it and don't ever sell, I would have to pay taxes in my lifetime. But when I pass away, the current tax code allows for there to be a step up in basis to fair market value at the date of death. Meaning all of those capital gains and taxes and growth that I received that I would have paid taxes on wash away, and my kids received those assets with the step up basis. There's no more taxes. Then they get the $50 million building and could start the whole new depreciation loss off of that higher value. Meaning the same asset can be depreciated over and over and over again. My kids now get to depreciate the $50 million building. They receive it tax-free, and better yet, now all of the, well, I don't want to go, that's too much detail. Let's just say they now get the $50 million and they can get that appreciation and continue that appreciation with those types of deductions. It's an amazing tax strategy and wealth strategy of transferring wealth to your beneficiaries. We'll talk more about that. There are other assets that also have similar tax benefits. Stocks, crypto. Let's just say you buy it for $100,000 and it goes to $2 million. You in your lifetime would pay taxes on it if you sold, but your kids would be able to receive it with the step-up basis if you pass away. There is a lifetime exemption. You can't be worth more than $13.6 million based on today's code. If you're married, it would be $27.2 million. There are some other cool tax strategies we won't go into today, but you could always gift that money to an irrevocable trust and have those assets appreciate to billions of dollars, billions with a B, and not pay taxes when you pass away, because technically they're removed from the estate and they're not counted towards your lifetime exemption. And so if that ever, I hope this is for all of you, if this is a problem that you may have in your lifetime, let's talk more about the lifetime exemption and ways that you could get around that, especially if you start early. Because the earlier you start, the more time you have, and that time and compounding will make a big difference. That's been my story for those of you who've heard it. I started as a teenager, and it's made all the difference to having more than I thought, at this time in my life. Let's actually get into an example. And then I'm going to tell you the best part of all this, because so far what I've shared is just kind of cool. It gets a lot better. This is a cost segregation study. I just want to break it down so you actually understand the numbers. This is an actual deal that Harris Investment Group purchased in 2021. Actually a really tough time in the market, because since then interest rates have gone up quite a bit. And typically gas stations are interest rate sensitive investments, which means if interest rates go up, cap rates go up and values go down because you're generating less income because of the higher interest rates. But if interest rates go down, cap rates tend to follow, and that means values go up. However, this particular deal, despite that working against us, we still made a 23.5% total return to investors and a massive tax benefit. Let's talk about the tax benefit. That's what we wanted to talk about tonight. We paid $16.9 million, and of that $16.9 million, how the IRS assesses real estate is you're buying a building and land. Land has been around for millions of years, and despite land perhaps evolving, it doesn't lose its value. So we don't get to deduct the land. The only deduction of depreciation that we get comes from the building, the real property contents, the equipment. And so everything that you see up there that's building and infrastructure, that's deductible. The land, however, is not. Well, something I find cool, because what we're trying to do for our investors is to pass through as much depreciation loss as we can to give them a tax deduction. How much do you think the land is worth? Look at that pretty backdrop behind that truck stop. It's about as ugly as it gets. It looks like my hometown, Amarillo, Texas. Flat, ugly, yucca cactus. That's pretty much Amarillo. So the land value here is almost nothing. And if you look at the cost seg study, the land value is about $400,000. The total excluded cost was $435,000. So they gave, as a part of the $16.9 million purchase, a land allocation of $400,000, leaving us with almost $16.5 million of deductibility of depreciation. Well, here's what's really cool about the Tax Cut and Jobs Act of 2017. When they changed the law that anything on a cost seg study that's a 20-year life item or less you can receive bonus in the first year, because truck stops are tied to oil and gas, which is energy, one of the other 7 subjects that the government has to focus on. The uniqueness of the truck stop is the cost seg studies report all items as 20-year life items or less. Every single aspect of the building is under 20 years, which means all $16.5 million gets to be written off in the first year. Well, what's cool about that is we could have paid cash for the building, right? And we'd still get $16.5 million of write-off. That's almost a 1-to-1 ratio. You don't get the land value, but everything else is deductible. So almost 1-to-1, right? However, what's so great about real estate is we have the opportunity to go and have a bank finance a significant portion of the purchase. So we only had to come up with $5.7 million to buy the $16.9 million building, allowing us to take $16.5 million and divide it by our investment of $5.7 million, which is almost a 3-to-1 write-off. 290% first-year depreciation to equity. That can be really powerful, but only if you can use the benefit, right? So let's talk about how that benefit can be used to make it more meaningful. But before I do that, I just want to explain any cash flow, and cash flow, we did hit over 6% cash on cash on this investment. The depreciation loss that we got can carry forward and continue to shelter the cash flow benefit, making the cash flow tax-free, essentially because you have the deduction to offset the taxable income of the cash flow. But if you don't use it, you don't lose it, it carries forward. It's called an NOL carry forward. Any unused depreciation that you can't use because you don't have enough passive income carries forward to the next year. So I want to supersize this, and this is, if you learn anything tonight, this is the best part that you want to pay attention to. Let's talk about how we can use it in a more favorable way. And that's when it comes to something called REPS status, Real Estate Professional Designation, REPS.
That was awesome.
Yeah.
I cut it on such a cliffhanger.
Incredible.
Yeah, right? And this is just part 1 of part 2.
Oh,
There's more to come.
there's a second half here. Let's go.
Second half. Yeah. And we will pick up right where we left off.
So if you have any questions for us or for Jason about any of the things that he just talked about, shoot us an email at contact@harrisinvestmentgroup.com, and we'll get your questions answered, because I'm sure there's going to be some questions and we'd love to talk about them. We'd love to have Jason on and talk about them. So be sure to send those in.
Jason is actually, so after he gave this lecture, he said he wants to come on the show and specifically talk about some of these topics, but in more depth, maybe more related to what our audience base wants to listen to or wants to hear. So shoot us an email. We will answer all your questions. In fact, Bronson will answer all your questions. You can get an email from Bronson, or you can get, a direct answer.
Let's go.
Yeah. All right. Part 2 coming up. Stay tuned. Bronson, hope you find your dad.
He's out there somewhere. Probably at In-N-Out. Cool.